In a nation of mostly farmers, ranchers, and small shopkeepers, retirement was rare. Now many of us work for large organizations and can look forward to a time when we won't have to work any longer, when we can retire to travel, go fishing, take up hobbies, or just take it easy. When you're 21, retirement may seem far away and unimportant compared to the possibility of war, world catastrophe, family breakup, or your early death. But chances are you will live beyond 60 and need an income. What do most workers do at 65? Yes. If you're in good health at 65, you have a good chance of living beyond 80. And if you don't work, you will need adequate retirement funds. You don't want to be poor when you're old. Social Security provides the major element of support for many retirees, but Social Security is not enough. Other sources of retirement funds are private pensions, savings, and annuities. More than 75% of retired persons live comfortably, and you don't want to be one of the other 25%. At 65, what is your life expectancy? Right. For retirement, you must balance present costs and future goals as you do when you buy insurance. Your retirement age and income will depend on your ability and willingness to save during your working years. What is a reasonable retirement income compared to your take-home pay from work? Good. You may want to retire at 60, 55, or even younger. The U.S. Army allows retirement after 20 years. So do some police and fire departments. But of course, few persons retire completely at 40. They may also run a motel or sell real estate. Some have retired at 50 or 60, and in the 1970s, early retirement seemed to be increasing. But in 1982, we saw the beginning of a trend toward later retirement, due primarily to the economy. We are living somewhat longer, and older people are making up an increasingly larger percentage of the U.S. population. It's been suggested that by the year 2000, the age for retiring with full Social Security benefits be raised. What would you guess is the proposed age? Yes. But that's just a proposal and perhaps won't be adopted. In any case, now you can retire at 62 with a reduced amount of the full Social Security benefits you'd receive if you were 65. There will probably be some similar provisions in the year 2000. The federal government's Old Age, Survivors, Disability, and Health Insurance program, called Social Security, is available to nearly all workers, and it will continue to be a major source of retirement funds. Where does the money come from? Correct. In the early 1980s, from 13 to 14% of your salary up to a maximum amount is paid to the Federal Insurance Contributions Act fund each year. Half of the FICA tax is withheld from your pay and half paid by your employer. Your tax money is not held for your retirement. Your taxes today pay for presently retired workers. Who will pay for your retirement benefits? Yes. You may have heard Social Security will go bankrupt and stop paying benefits. Don't believe it. As long as FICA taxes are collected from workers, there will be funds to pay benefits. But an increasingly large percentage of our population is becoming elderly because of the different number of persons born in the 1930s, 40s, 50s, and 60s. In 1960, one person was retired for every 4 workers. By 2000, one person will be retired for every 2 workers. FICA taxes will be higher and benefits limited in some ways. Nearly every worker in the United States, except some government and part-time workers, is covered by the Social Security retirement system. And Social Security is not just a retirement program. It has important survivor benefits and considerable social welfare aspects. Most married workers who retire at 65 will receive from $4,500 to $7,800 per year from Social Security. Who would get the higher amount? Right. When a middle-income family lives on $25,000 per year, a $400 per month Social Security check won't be enough to retire on. And even if you have some savings, you won't know how many years it will have to last. Can you buy some sort of insurance that will guarantee that your money will last? Yes, you can. It's called an annuity. An annuity is the opposite of life insurance. You pay for life insurance, say monthly, during your life. Then your beneficiary receives a lump sum. To establish an annuity, you pay a fixed amount which guarantees you monthly payments. With a straight life annuity, the payments cease when you die. Life insurance benefits survivors. Whom does your annuity benefit? Yes. You can pay for an annuity over a period of time before you retire, or with a single payment at time of retirement. Of course, you could just invest the money and live on its income. But if you don't need to leave the principal to your heirs, you might choose an annuity, which would probably provide a somewhat higher retirement income. Each of us has unique needs. Actuaries are statisticians who can work out countless ways for annuity salesmen to meet your needs and to make a reasonable profit for the company. In addition to a straight life annuity, you can get a guaranteed minimum annuity, an annuity certain, or a temporary life annuity. These differ according to the length of time you receive payments and whether or not a beneficiary receives payments when you die. Why buy an annuity instead of investing the money? Right. Most of us wish to leave at least a moderate bequest to our children, even if they are grown and fully self-supporting. But we certainly don't want to become a financial burden to them when we retire. What can provide a partial solution to this problem? Yes. Many retired persons own their own home, mortgage-free, and these homes make up an important part of their assets. There are ways that homes can be sold and rented back, or can be contracted for sale with the provision that the sellers maintain possession until death. The sale proceeds can provide retirement income. In addition to Social Security and savings for annuities, retirement income has increasingly been provided by employer plans. Nearly 2/3 of all U.S. employees now participate in these plans. employees contribute a portion of the costs in some plans. More than $25 billion is being paid out each year by private employer retirement plans. Retirement funds are the largest owners of corporate securities. They also provide huge sums for real estate financing. What's the traditional word for retirement payments? Good. Large employers provide retirement plans to attract better employees and to meet the demands of labor unions. A pension-year retired employee 1% of final pay for each year of service. 10 years, 10%. 40 years, 40%. If employees contribute to the pension plan but die before retirement, their contributions may be refunded to their heirs. While many risky or strenuous jobs provide for earlier retirement and a few sedentary jobs for later retirement, most retirement plans begin at a certain age. What is it? Yes. The Employee Retirement Income Security Act, often called ERISA, or the Pension Reform Act of 1974, regulates retirement plans. This has reduced the number of such plans, but the remaining ones are stronger. The pension law requires the vesting of benefits. This means that after employees work for a company a certain period of time, usually 10 years, they have a permanent right to some later retirement benefits, regardless of job change or interruption. What is the pension law often called? Right. Benefit Guarantee Corporation, which guarantees certain retirement benefits, somewhat like the Federal Deposit Insurance Corporation guarantees certain deposits. Does federal law require organizations to have pension plans? Correct. It is mainly intended to ensure that employees who have earned pensions will actually get them. The IRS code also encourages the stability of pension plans by providing tax benefits for plans that qualify. Companies may deduct their contributions to qualified retirement plans from their income tax, and employees do not have to claim those contributions as immediately taxable income. To qualify under the IRS code, a company pension must, among other things, be funded. This means that the company may not simply pay benefits out of its current income. Instead, it must set aside a conservatively calculated amount each month, which it invests prudently, often in a trust fund. If you work for an organization that does not have a pension plan, or perhaps even if it does, you may wish to set up a tax-deferred individual retirement account, an IRA. If you're a doctor, lawyer, CPA, or owner of a small business, you may wish to set up a retirement plan under the Self-Employment Individuals Tax Retirement Act of 1962. Can you think of what this kind of plan is called? Good. Individuals can set aside a certain portion of their income in Keogh plans or IRAs and subtract that amount from their taxable income when they file their income tax returns. The limits in 1982 were 15%, up to a maximum of $7,500 for a Keogh plan and $2,000 for an IRA. The interest or dividends are also tax deferred. What is an IRA? Yes. Your tax is deferred until you retire. Then you pay income tax on the money as you receive it. If you withdraw the money before you're 59 and a half years old, you also pay a penalty tax. Before 1982, many individuals could arrange their own tax-deferred retirement programs through Keogh plans if they were self-employed, and through IRAs if they were not covered by a company pension. Now, even employees who are covered by a company pension can have a limited IRA with income tax deferral. You never pay tax on money that is tax-exempt. Do you eventually pay tax on money that is tax-deferred? Right. The eligibility for IRAs was broadened to encourage saving and to help the economy by providing available funds for increased industrial productivity. Now, thousands of financial institutions are competing for your IRA deposits. Just walk into your local bank, savings and loan, brokerage firm, credit union, or insurance company and ask for the IRA forms. It's easy. Banks and savings and loans mostly issue 18-month certificates of deposit tied to the money market, while brokers may let you specify your securities package. You may also buy an individual retirement annuity. What makes IRAs attractive? Good. If you're the president of GM or a great pro halfback or a 400 hitter or a rock star, you may work out a non-qualified deferred compensation plan which pays you part of your income in later years after you've hit a slump or been fired. Most of us don't have that kind of problem. You may be taking home $2,000 per month when you reach retirement age. Which of these budgets seems the most likely goal for your monthly retirement income? Yes. When you're 65, you probably won't see so well or ski so well, but you may be able to work a little and enjoy life if you keep your health and save some money. The Social Security system, employee pension plans, annuities, individual retirement plans, and tax laws are all designed to help you. Good luck.